Okay, hi everyone. I'm starting the meeting now. Okay, the market is currently still slightly bullish. All right, and firstly, what is driving those sentiments? I've mentioned that in the last video, we are looking at economies reopening. All right, and then one of the main thing is that the Federal Reserve has been printing trillions of money. So I'm showing you this graph. This is the Federal Reserve total assets held by the Feds. Okay, so this has been the QE1, QE2 since 2008, '09, and all the way until 2014, where they stopped their QE, quantitative easing. All right, until recently they starts to reduce their holdings. Now over here, right, in end 2019, they start to increase their purchase again, as they find that the economy is like stalling. All right. So what happens is that when the COVID crisis happens in February, March, they have been printing the money tremendously. From 4 trillions of assets, bonds, government treasuries. Right now, they are holding more than $7 trillion of assets. So this is how they print the money for the whole economy, to lend money to the government. I just draw a simple graph to show what is actually happening. All right. So from the Federal Reserve, what they do is they print money to buy U.S. government bonds and corporate bonds. Okay. So what happens that these bonds enter into the Federal Reserve as their assets. Now, what happens that this money that flows through to here to the U.S. government and corporates, they will deposit this money into banks. So what happens that these banks do is that, due to the reserve ratio, most of the developed countries' economy is roughly about 10%. So they'll put or deposit this 10% reserve, right, of money, or in terms of bonds or investments, with the Federal Reserve. And the rest of it, they are able to lend 10 times this amount of reserve ratio. They lend this money to credible individuals and companies. I mentioned here is the word credible, meaning to say you are not, you're not bankrupt, you're not in need of money. These people, basically, they are rich, and they are credible. They are able to repay any debts that they borrow from the banks. So the banks are willing to lend these people because they find that they are very likely to repay any loans. All right. So these people tend to be rich individuals, rich companies that actually don't really need money, but they just want the money, keep it in cash, or they use it to invest in or do acquisitions. So because of this whole money printing that's happening, it is causing a so-called inflation. They rise in prices. And how does the individuals and companies hedge this inflation? Is that instead of using the money to employ people and grow their businesses or grow the economy, they use this money to buy assets. And usually these assets are like the stock market, for example, because stock market is faster, it's liquid. In current times of need, you want liquid cash. With this, that's the reason why the stock market has been moving up tremendously a lot, and this has somehow made a lot of the economists, the analysts, like Buffett, how did, with the economy so bad, with expected GDP contraction between 6 to 8%, how did the stock market rise until so high? So this is not the first time it has happened. It happened in 2008. It has happened in 1972, when they took away the gold standard, and then they go into money printing, and that caused the stock market to rise tremendously. This is actually what is happening in the market due to all the money printing, and it causes this rise. So at this moment, the market has been doing a lot of gaps. There's a lot of uncertainty. They think the economy is opening, and then suddenly there is a second wave news happening in certain states of America, like the Texas, California, San Francisco. All right, so market gap down, and but then they say economy is recovering, and then the Feds are still printing more money, market gap up, and then a day after market gap down, then now move up and then gap up again. So this 1 week is kind of like quite haywire, we do not know whether it's going to be up, going to be down or not, so but overall people are still buying, investors are still buying into the market. Okay, so at this moment, the good sign is that it's trading above this 200-day moving average. So it's kind of like making people, traders, to look up and start investing again, because it's above the 200-day moving average. Now, if we look at the Nasdaq, where most of it are being the tech companies, your Microsoft, Amazon, Google, Apple. So this has made a new all-time high, trading at a much higher price, and most of it has been run by technology. And technology is, despite the COVID, or despite the pandemic, it has not slowed down, because most of the people access services through the internet. All right, so that's the reason why the Nasdaq has been up, and in fact, some of it is also by medical stocks. All right, it's also in this Nasdaq composite. Let's look at, this is Hong Kong market. So beforehand we have this COVID sell down, and right now it's trying to recovery. Now this is a kind of pattern that I do not wish to see. It's like it's doing a trending pattern upwards. All right, and this is what we know as a counter trend rally. Okay, why? Because the main trend, right, as you can see in the longer term, is down. All right, like something like this, it does a counter trend rally, and as it fails, it moves down. A counter trend rally again. This is like doing the protest, and then it comes down again. Okay, so this type of trend is not really nice. So the STI, Singapore index, is also doing a similar kind of thing. It's doing this trend, and to me, I don't feel comfortable with such trends, which means to say, even if this starts to move up, right, I will not be like investing everything into it. Okay, I'll still be leaving certain cash, hold off my margin purchases, and we'll see what's going to happen over here. As it move up, probably take some profits, or what. So at this moment, last week I mentioned that. Okay, right over here, last week I mentioned that the selling is happening, and then we expect it to come down to test the trend line. All right, previously my trend line was here, so I readjusted, okay, to compensate, see how is it. So at this moment, there is a possibility, higher chance, maybe more than 50%, that it might rise and rebound again to test this top part of the trend line. Okay, why? Because overall in the whole global market is still slightly bullish. Okay, it's slightly bullish because of all the money printing, government stimulus plan, and last video I also mentioned that the government stimulus has been upholding or supporting the whole economy, so supporting people's lifestyle. In this example, I mentioned that the Federal Reserve print money and buy corporate bonds, right? Now, what happens is the government, despite depositing the money in the bank, right, they are actually doing a helicopter. They are actually throwing down money straight into the citizens' own pocket. Similarly, for our Singapore government is also doing the same thing, where we have our resilience package, what care and support package and such things, where the government has directly helicopter the money into our pockets, and want people to survive and spend the money, and use the money. So this is what is supporting this whole, what I'll call a counter trend rally at the moment. All right, so there is no signs that tells me this next second wave drop, right, will not happen. There's no signs that's telling me that at the moment. Okay, so this is what I think in the long term. So as we also know that currently Beijing, the past week, is imposing a new lockdown, okay, for fear of a second wave virus. Having like 100 new cases in the past 1 week. Okay, so they are taking drastic measures to curb this second wave from happening. Okay, so we just have to be mindful of all these events. Right now it's actually a very news-driven kind of stock market. So we have to bear in mind whatever news that comes out is going to affect the market, positively or negatively. So what should we be looking at, as investors? I did receive a lot of queries about Singtel. So let's look at Singtel. Personally, I look at this is that from the pattern of this, it's like an inverted cup and handle pattern at this moment. All right, and if you were to break down this trend line, right, it will be very negative for the stock, and it will probably be trending down even longer, even more. So at this moment, we still should not be investing in Singtel yet. All right, despite that it might move up a little, 260 to 270, but that may be the end of it, or it will just trend along this trend line. Why I think the higher probability it will just move up and down along this trend line, until there will be some catalyst, some bad news, and it will just break down. Okay, so we should not invest in Singtel at the moment. So we just wait if it comes to a low point and conditions are better, or if there's a bad panic, we can just buy Singtel at a low price. Yang Zijiang I've mentioned quite a few times. So at this moment, it's been trading sideways. Okay. First mentioned somewhere here, it turns up, try to stay above, and then now comes down due to the recent events, past week events. So at this moment, it seems to be turning up. All right, and we just be mindful that all these additional levels of resistance that might happen or prevent the buying up. Okay, so this is Yang Zijiang, currently about 4.5% dividend yield, P ratio of 7.2. OUE commercial. Oh, anyway, by the way, Singapore is going to reopen, second phase. Retail shops are going to open, office worker are going to step up in returning back to office. So in terms of commercial retail space, there might be a positive effect. And why I see that in this space, in the REITs, we have the retail REITs, commercial REITs that are growing stronger. All right, and I've mentioned this about two to three videos ago. Okay, before the recent rally. So what happened? The strongest among the REITs are of course the logistics REITs, because they are still providing a lot of services. People are buying online, and there's a lot of delivery to happen. Okay, so the logistics REITs mainly all has already went back up to a very high price. So it's not a good time to invest in these companies, like Ascendus REITs. Okay, so it's already trading quite a high price. Your yield is only like 3.6%. All right, PE ratio like 20. So it's not even like Maple Tree. Yeah, Maple Tree Industries, it's been also trading at a high price at its previous high of COVID time. Okay, so it's running at 4.2 PE 20. It's quite similar to Ascendus REITs. So I mean, as investors, it is not a value price for us to buy and accumulate. But in terms of trader, depending on how long this musical chair is going to run before the real crash happens, there might be some positive news in this for it to break its all-time high, and trade higher. Okay, so this is the Maple Tree Logistics. So just now I turned out OUE commercial. Okay, it's doing a nice pattern here. Probably a cup and handle. So yeah, we like to see this testing this resistance, no, around 43 cents, 43 half, and hopefully you can see it break this resistance and trade higher to a target price of about 50 cents. Okay, so this is OUE commercial currently giving about 8% yield, PE 16. All right, it's about 23% discount to book value. Okay, some of the property stocks are having some positive pattern. This is Yenlot has been trending well, and then it recently have been trading above the 200-day moving average. Okay, at this moment there's a lot of volume coming in, in supporting the prices here. Okay, so Yenlot belongs to a certain group of SME bosses, a group between like Wilma, Ron Sim, and all those rich SME bosses. So what happens is recently there is a news that these SME bosses are bringing perennial holdings private. They're taking them private. So perennial they offer price roughly about like 95 cents. Wilma, Ron Sim, and a few bosses they take perennial holdings to a private, and the price that they are offering is still about 20% discount to book value. All right, so for this Yenlot, um, currently is about 60% discount. And bear in mind that they do own properties around, mostly also in China. So therefore, probably that gives the reason why the discount is so steep. And currently it's giving about 5.7% yield. But do bear in mind that the debt is quite high, roughly about 9 billion, about 30-40% of its total assets. Okay, so this is probably something that we can look and is seen, and from the way the chart pattern looks like, it might be looking to turn up. Okay, so at this moment, it has not formed a base. It might form a base here over a big pattern. We like to see how it turns out, and if it's like low volume trending down, is somewhere we can look to accumulate, like 110, 105, 110 area. Okay, this is Yen Lot. And Hong Kong land. Last week I mentioned about Hong Kong land. So I mentioned that it's going to come down. So we are looking here at around the $4 area. So recently, this few bars have a lot of volume coming in to support the price roughly around here. So we like to see the next few days if we can move sideways for like another 3 or 4 more days then there's a high chance that it might turn up. Okay, so we just have to monitor this. If this $4 is holding well, is a stock that we can look in to. Okay, it's giving you like 5.54% dividend yield, is greatly undervalued, mostly in Hong Kong properties. Okay, we now head on to the traders portion. All right, for traders, what should we be looking at? Okay, the what happens right now is that the past week past 2 weeks what we saw is a rally in big cap stocks. We saw STI rallying, and what happens now is that we are starting to see small caps that are running. Okay, when we start to see small caps that are running, right, we should be very careful. All right, this is Jumbo. Okay, the past 1 week has this move up very nice. Now it's testing its 200-day moving average. So we just have to see how it turns out over here. Do not chase stock. Do not buy here at this price. We just see how it turns out. If it comes down shallow, we just look at opportunity to buy. So Rex International, 2 days ago, it had this rally, and then it paused. So this is a strong rally, and this pullback is a little bit deep. So what happens is we want to see this trend sideways, consolidate, see if you can form a nicer pattern or a tighter pattern, and then we look for opportunity to trade to the stock. So we want to find something like this, a tight pattern, and then we can look to enter like when it's on a low volume day. So I'm mentioning about the oil is because if we look at this is the WTI, West Texas oil is still staying strong. It's still trying to trend up or turning up. Okay, so in terms of our oil and gas industry, Sembcorp Marine is already out of the picture. They have a deal going on, all right, and then Capcorp also have a deal waiting for Temasek offer, which only leave us with small cap stocks. Okay, so these are some of the small cap stocks that I'm looking at. Rex International is one. This is Mermaid. Okay, so this pullback is a little bit deep. So we like to see how this one turns out. If you can just consolidate sideways, similar to Rex, we can look to um, trade into this stock. This is Mermaid. Okay, this is Dynamac Holdings. So similar pattern to Rex and Mermaid, and these 2 days of up bar with volume is a very positive news. Okay, positive sign. So what we want to see is you can rest shallow or in sideways pattern, or even test this 0.126 and come down, and then that's where you will want to buy into the stock. From here to trade to the next level, roughly about 0.14. Okay. So among the three, personally, I feel Rex is has a much stronger pattern. Okay, Rex International. Why? Mainly because of this run and it's trading above the 200-day moving average. So from here you can see Rex is actually is a much stronger position technically. Okay. Most of the medical stocks are already down. I do not expect to see them running. Riverstone, Top Glove, and all this. But this MedTech seems to be holding quite well. Okay, so there are a lot of sellers happening in the 28529 area. Okay, so it has been trying to bash this 29 area for a long time. Many times. Been testing a lot. So in such case, right, is that if we were to slowly inch up and trade around here, and when the volume like today's volume is like so low, right, there is a high chance that it might just burst through the next few days. Okay, the volume today is extremely low, so this is a key sign something might happen in the next few days. All right, so we'll watch out for medtech. So you can see that most of the stocks I mentioned is going to be penny stocks. Like G Invacom, it has a big run today. Okay, so you break off this area. So in this, there is a possibility that you might have one more day. Okay, it's a high risk. So unless you know how to trade this type of stocks, you go in, you have to come out fast. Okay. If not, you just wait for the next pullback to happen, and then go for the next run. Okay, this is something that we can look at. Had a nice run. Okay, and then there's a sell down. So don't be too eager to enter this first. We just have to wait, let it settle sideways, let the volume drop, quiet, and then we can look to find opportunity to trade the stocks. I mean, I don't know. To me, I don't even know what. First time I'm hearing this company. Okay, Tuan Sing had a nice move recently. So now with this tail, right, expect it to pull back. All right, and we just like to see how it turns out, and then look for a new opportunity to buy into the stock. Mainly is because of this 2 days rally. Okay, Moya Asia is doing a nice pullback at this moment, and volume is starting to pick up on this move. So be mindful this is a penny stock. So I'm expecting some move in the next few days, probably to 7 cents area, or it might even bash up, with high volume. Okay, this is Franken. This has more fundamentals to it. 3.7 dividend yield, roughly an ROE of like 15%. So it is quite good, quite decent. Electronic sector, together with AEM, IP and all this. So right now, at this moment, there's a nice rally here, and it has been trading sideways, getting very tight. So if we trade somewhere to around this area, right, we have to be mindful to look into the stock really, because it might burst in either direction, up or down. Okay, so in this case, the likelihood of up is higher. Okay, based on this move. And one last stock, I like this stock. It's an all-time high stock, but I also is sometimes hard to trade. This one is in Hong Kong. So with right now economy all returning, opening up, people are starting to go and makan and all that. This is Hai Di Lao. Okay, previously this is the all-time high price. Okay, somewhere here I think 2 weeks ago I mentioned that it's time to pull back. So it really did pull back, and today yeah this move, okay, is quite a positive sign. So we can look at do a short-term trade probably from around this area, all the way to testing this. If the stomach for it, then you wait for it to break above this, and then continue its new trend of all-time high making. Okay, so this is Hai Di Lao, a new IPO stock from listed in Hong Kong. Okay, so this is the end of it. In summary, I'd like to mention that um, even though the market right now is slightly bullish, but it is an artificial kind of bullishness, whereby it is the Fed that's printing money, government stimulus plan that is holding the whole economy up. And if we look at the real economic situation, global trades are down, travels are down, businesses are down, people are unemployed. So in terms of the real economic fundamentals, it's not supporting the stock market rally. So as we try to trade and invest in this market, is a very tricky situation. So we just have to bear in mind all this news that is happening, before we place big bets into the market. All right. Do you guys have any questions? If not, thank you everyone. And at the this meeting.